Hello all, we will be starting the meeting in just a couple of minutes. Apologies for a little delay. Good morning all. We are now starting the session. A very warm welcome to all participants. Myself, Anupam Petkar, Think Tank Chapter Leader, welcomes you all to Think Tank Global Conclave Knowledge Series for all stakeholders in finance, corporate affairs, industry, and profession. Think Tank has been in existence since decade with conferences, conclaves with CEO, CXO, CFO, panelists. Our panelists are finance leaders working in reputed companies since many years and have deep domain knowledge. Think Tank platform has now crossed for almost 13,000 views through its digital medium. Our participants and experts are with rich experience in industry and profession who have done qualifications such as ICAEW, CFA, CPA, IM, CA, CS, CMA, ISA, FRM, IFRS, BTech, Masters, PhD, having global experience and sharing experiences and knowledge consistently since over a decade as a reach out initiative globally through our okay. We also unlimited resources. As participants are aware, today we will be covering topics on taxation series with latest developments, corporate series, financial reporting, FRRB, IndAS framework with real life examples, company analysis, CSO, IP reviews, NAC halt impact, latest developments, including discussion papers, reports, orders, judgments, latest and market trends. We'll be covering various topics like vital hearings in tribunal, financial reporting, and trends in FRRB. For it is financial report reviews in IndAS and important tax developments regularly as requested by many participants, wealth management, charts, and market trends, digital, etc. As has been suggested by our participants in our through our WhatsApp groups in coming weeks. We all request all our participants to subscribe to our Think Tank YouTube channel for watching webinars and conclaves and join, connect, and network on Think Tank webinars group on LinkedIn, which has been specially created on the suggestion of many participants and panelists. We once again welcome all participants and speakers and start the series. May I suggest Sandeep to take over this. Sandeep, you are on mute.
Thank you, Anupam. Let's start this session with the IPO series, and I'll take up the some of the IPOs which have gone by actually first. Uh, and to begin with, I think the disclaimer is the most important, where we are very clear that the speakers and participants would like to inform all those who are attending that the speakers and the participants are expressing their own views and not the views of any organization, and the speakers are not responsible for any investment decision made based on discussion during the session. And it'll be prudent for all who are attending to consult their own stockbrokers, investment advisors in their own country before investing or buying or selling any investment or any financial instruments. Please take note of that. Thank you. Um, we had done this RAILTEL IPO analysis, and it looks like the general public, in fact, has if you saw the oversubscription, retail had actually subscribed to quite a bit of the offer. Now it got listed yesterday with a 29.15% higher subscription, the rate, the price, than the offer price, which only means that the analysis which we were trying to do, and I think more or less, we feel that the general public has actually considered this not only as a government IPO, but also the fact that this is an IPO which is relating to uh, from the IT point of view. So when we said that it has a lot of feel where it could become one of the backbones for IT development across India, that is Wi-Fi, based upon the fiber to the panchayat schemes where Wi-Fi will be made available to everyone. I think that that's something which people might be taking, because from if you see yesterday's um, you know trading in the market, actually the markets went down substantially, whereas this on the first day netted out 29.15% return, or it opened higher. And the main part is that it did not go down after opening higher, which is quite good news for that company. Uh, we then come to the ongoing HERBANA Industries IPO, where the QIB portion was oversubscribed 67.45 times. HNI, including the the NIIs, including the HNIs, with 271.15x oversubscription, whereas the retail component is only 11.84x. Uh, in fact, we would like to actually come to this. We had not actually taken any analysis on this IPO. The fact remains that this IPO would put in fresh issue of equity into the company of rupees 60 crores only, whereas the offer for sale by the promoters would amount to 565.2 crores. Now, if you imagine what is happening here, there are public issues which are coming in, offers which are coming in, where promoters are trying to make good the valuation on the markets, because the markets are doing well, and they are trying to encash um, the substantial increase in the markets plus their own company's valuation. Um, Whether or not this will sustain in the long run or in the short run is something which we'll need to check out. Uh, and if you see the retail portion, they have not really gone and invested in a big way, uh, possibly due to that reason. Uh, the listing will take place on the 5th of March. So let's see how it goes. The next one I would like to take is Nureka, where this also got subscribed uh, about 39.93 times. It was a small IPO. Uh, the fact that the IPO was small in the sense qualified institutional was only 3.1 times, non-institutional, including HNIs, was 31.59 times, whereas the retail investors put in 166.65 times, which is quite good, in fact. Um, Here, we don't have a view on whether or not uh, in the long run, how would this pan out. But a fact that it got listed at 615, which was a jump of 53.75%. And yesterday it closed at 645 points. Yesterday it closed at 678, which means it is sustaining. In the longer run, we need to check out how this goes. We come to the IPO, which is likely to open on the 3rd of March, and the closing date is 5th of March. Uh, the listing will take place on the 16th. Now, the first thing which we need to check out again, like in the case of HERBANA, is that the fresh issue is to the extent of only 123.52 crores. That is the amount which will go into the company. And the offer for sale is about 472.9 crores, which is huge. And if you see, one of the things which I would like to highlight is the fact that, if we annualize the earnings and the diluted equity capital, the asking price, that is the offer price, is at a PE of 47.24, which is extremely aggressive. Now, why am I saying that? The reason is very simple, because again, you had the EPS of 10.51 and the average return on net worth of 12.96. The issue is priced at price to book of 6.26, which is again big, with the NAV based on the NAV of 91.78 as of 31st of December 2020, and at a price to book value of 3.77 on the expanded capital base of 152, the NAV being 152.51. So all in all, this looks like extremely heavy price on the offer. From the, again, you can imagine it would be so, because the offer for sale component is much larger, or I would say approximately 4 times the amount of the fresh issue of shares by the company. Let me take you through the SWOT analysis. It's in a good space where it in fact, the sectors which it covers is nuclear energy, defense and space sectors, which are expanding. And moreover, the government of India is actually wanting these sectors to grow, and a lot of additional orders are coming in through the government and the other companies through this sector. The company has reputed, uh, clients like Nuclear Power Corporation, the DRDO, ISRO, and Bloom Energy. Uh, as I said, supported by the government. What will happen? And here's the caveat: because of the opening up of these sectors, what is really happening is the large conglomerates, actually, like the Tatas, the Mahindras, and other big business houses, are entering this sector. Will the sector be swamped by these players? Is something to look at in the future. So, will this company be able to sustain the competitive pressures? Is something we need to check out. Its order book is quite good at 336.2 crores against its revenues of 235 crores in 2019 and 225 crores during the 9-month period ended December 2020. So it's been quite a roller coaster for this company. And as I said, large expansion possibilities, that's the opportunity, with the Indian government stressing on the Atmanirbhar for the defense sector. Let me come to the weaknesses. The company does not have any long-term supply agreements. Okay, that's one of the biggest factors. The sector is opening up with large groups, as I said, entering the sector. And there are two pitfalls which can be looked at. Managerial personnel, the HR personnel, if there is any attrition to that effect, and people are picked up, not only will there will be a brain drain, but also the fact that the problem of technological advancement of products and research will have a hit. And for this company, being a smaller company and possibly not able to sustain uh, this brain drain, is something which might impact the company. The amount of you know money which is being raised is for repayment of the debt and working capital requirements. So what it means is, if you look at the cash flows, uh, if you go through the RHP properly, there are negative cash flows as far as the September figures are concerned. So, which means there is a problem on liquidity for this company uh, of late. Possibly this might be because of COVID, but you know, as we go on with this, is something which needs to be kept in mind. There's concentration risk of orders from 5 companies only. It's about 97%. Now, if we total up, it comes to 97%. The RHP says that it is 88 to 90%. I'm not sure how that is worked out, but if you look at it, Nuclear Power Corporation is 27%, ISRO and DRDO uh, make up 21%, and Bloom Energy is 49%. So from that point of view, it's about 97% of the orders come from these 4 companies alone. And it's something of a risk. If one company stops giving orders, this could be an impactful event for them. Strangely, there was a fire which had impacted the company in May 2014, and the secretarial records, it is mentioned in the RHP, were lost due to the fire. They have been able to retrieve everything, is not everything, retrieve a lot from the MCA, but a lot of records are not available yet. The next risk is the risk of foreign exchange, because Bloom Energy is an export component. 49%, as I said, is Bloom Energy orders. So all in all, the export orders come to around 52% as of December 2020. So it is likely to impact, because if you look at what has happened during the last a couple of months, the dollar has gone down. Um, the rupee has actually uh, been strengthening, except for yesterday when the markets actually fell and the rupee really took off, or rather, the dollar really took off. So this is a risk we should keep in mind. Now, even before the IPO, the promoters had pledged 4.74% of its equity. So one should look at that, and possibly they might be able to repay the whole amount once the IPO goes through. Then there are issues on credit rating, where the credit rating is triple B plus stable, or A2, depending on whether it's a long term or a working capital requirement. So in short, from that point of view, if there is a problem on working capital front, this could get impacted. The other last thing which I want to look at is the strict environmental regulations, which the government is really uh, tightening its screws on. Uh, the company, in fact, has a lot of environmental clearances, or maybe may not have all the clearances which are required. But if the government really has its way, then it could be a problem with the issues on the environmental clearances. All in all, with in a summary form, in nutshell, which I would say, the issue is aggressively priced. I personally do not like issues which have a very large percentage being an offer for sale, and not much of the amount going into the company itself. One thing which should be looked at again is, I've not mentioned it here, just prior to the IPO, uh, there was one round of a pre-IPO investment made by Axis as well as SBI, uh, at a slightly lower rate. I think it was around 434. So, you know, it's something where I won't go full heartedly, I should say, uh, and recommend this IPO, because it is extremely aggressively priced. That's all from me. Thank you.
Thanks, Sandeep. That was really great. It's always better to know before we invest. Uh, Anurag, are you there? Anurag?
Hi, sir. I'm here.
Hi, Anurag. Do you have a presentation like you want to share your screen?
Yeah, sure. Once.
Yeah, yeah. It will be great if you can start, and we'll look forward to hear from you.
Uh, is it visible?
Uh,
Not
no,
not yet.
not yet.
1 second. My screen sharing has been paused. So,
It says has started screen sharing, but can't see it.
1 second.
Yeah, maybe you
Yes.
can stop it and again try.
Okay. share things, share again. There is a message, your screen sharing is paused. So how to resolve this,
Wait a minute.
Aditya?
Just one sec. Can you try now?
One more time.
So when you do a screen share, you will get a lot of icons and you have to select one icon,
Yeah.
which is your presentation.
Okay. Let me try again. Is it visible?
I think there's some issues.
It came on briefly and it's gone again.
Okay. There is a constant message that is your screen sharing is paused. So
If you change your screen, so the moment you share your screen and you change that screen to other screen, it will pause. So you come back to the main screen wherein you are presenting, that will help you. You cannot change the page. The moment you move to the other screen, other window, it will pause your screen share. So you have to be staying on that screen.
okay. Let me try once again. So I guess we should continue without this sharing, or
Yeah,
shall I?
you can start over
Hello?
and
No,
we'll
no, no.
figure out.
The webinar on Tashila, but I was presenting, so I just disconnected. Tell me.
Sandeep, just can you mute yourself?
Why? What? Just one second.
Yeah, Anurag, you want to go ahead with without the presentation? We are good. Like you can start over and we'll figure out how to put the presentation up. Yeah.
Aditya, can you
Yeah.
load the presentation?
Yeah, I'm just pulling that up.
You
Yeah.
can load from your side.
Yeah, I'm pulling that up. Yeah. So Anurag, you can start. Yeah, that will be good.
A very good morning to all of you, and I must thankful to the think tank team for inviting me to present this lively thing. I guess the screen is visible to all of you now.
Yeah, the screen is visible. You need to start your bring your presentation up on the screen.
One second, I have to put this. Okay, so there is a disclaimer that I'm just passing this because all of us are very much aware about the do and don'ts. Yeah, next slide. It is think tank conclave related things. This webinar is basically sponsored by the think tank team. We must be thankful to our technical team members, Mr. Anupam, Aditya, Mitesh, Sandeep, Yogesh. Let me brief out something about this think tank group. It is there from almost a decade, and we have got so many intellectual peoples with us. We have got some CFAs, we have got some CWA pass outs, we have got CPAs, IM pass outs, even chartered accountants practicing globally. They are doing a very great job. They are serving their community very nicely. Yeah, so the topic assigned to me, I'm just coming to the topic. The topic being assigned to me is taxation related updates. Aditya, can you please open the slide number 6?
This one?
Yeah.
Okay, perfect.
Okay, so my today's presentation to be divided between two things. One is related with direct taxes and another one is related with indirect taxes. Okay, so GST. So let me start with recent decision that is being given by Honorable ITAT, that is Mumbai bench. It is of TCS. This is Tata Chemicals. Some very brief things to be pointed out here. First of all, we should share the departmental view. What was the case? What was the background? And how the company, the legal representative of company have proceeded with. Basically, it was something that is related with 2003, I guess. Some a payment was being made by Tata Chemicals to its group concern, that is Tata Sons, around rupees 3.7 crore. That was at that time, 2007. And department has disallowed this expenditure. The departmental view was that the Tata Chemical have got their own well-established logo, that is Tata Chemical itself, and it was quite sufficient. The assessing officer was of a view that there was no necessity to pay someone else for a particular say logo or say particular brand. Okay. And while going through the Tata Chemicals documents, the assessing officer was also pointed out that the payment of the amount that they were addressed it as a premium. Okay, that premium was under mandatory direction given by the holding company, that is Tata Sons, and it is not related to the business. It is in the assessing officer's opinion, there was no business consideration. Okay. So on this ground, the department has disallowed this expense totally. Okay, and more or less, even the assessing officer was of a view that the Tata Group is one or more same thing. So one is not entitled to pay himself. Okay, and on these grounds, they have disallowed the expenditure that was being claimed by the company. The company, the Tata Chemicals, proceeded further. They have filed an appeal with CIT appeals, and the appeal was also being rejected by the Honorable Commissioner. So they have decided to proceed further. They have filed an appeal with Income Tax Appellate Tribunal. The jurisdictional officer was Appellate Tribunal, Mumbai bench. Okay. So they have fighted on some very interesting grounds. It is assessees was suggested that collectively the brand would match the brand equity, and the brand, that is Tata, is a very well-known international name. This is the submission that is being given by the representative of Tata Chemicals before the Honorable ITAT. They have pointed out that the brand value is among top 100 brand values that is being suggested globally, and even it is the #1 brand. Even they have referred to the latest valuation that was being given by 2020. It worth around 20 million pounds. So they have suggested, or say they have submitted, that we are being benefited by using this brand. So we are very much entitled to pay and claim this amount as a deduction. Okay. So that was the two point of submissions. One is by the assessing officer, by the department, and one by the Tata Chemical. And the final verdict in this case, it is basically a landmark judgment that this amount that is being paid by a company to its holding company is being allowed expenditure, and the section under which it is being allowed is section 37 subsection 1. We have got certain parameters by going through this section. This section specifically asks for commercial expediency. This section is not concerned at all with any actual profit that can be related with the outflow of expenditure and the actual benefit derived out of this expenditure. It basically suggested we have to check whether the expenditure is actually incurred, and the expenditure is providing some commercial expediency. The Tata Chemical have very properly represented themselves, and they have simply suggested that yeah, it is in relation to the line to this concept of commercial expediency. So it is going to be a very landmark thing for all of us, and even to students also. Some students, those are basically reading this corporate law, the company law. We have learned about this separate legal entity concept also. The department was of a view that this Tata Chemical and Tata Sons is nothing but one or more same thing. But the honorable ITAT members have correctly decided that no, we have got a different company, that is Tata Chemicals. We have got a different group, that is Tata Sons, and because of this separate entity, one may make the payment to another, and if it is of the benefit of the company, there is nothing wrong to claim the amount as an expenditure. So this was the verdict, and I guess this will help a lot of people who are basically fighting in like cases. So this was the brief about this direct tax thing, and I'm moving to GST related updates. We have got some very recent things in GST also. Aditya, I need this slide number 10. Yeah, slide number 10, this LNT. Yeah. So yes, we have heard about recent searches made by this GST department, and very recently, even in this last week, this LNT has been fined by 30 crores, by rupee 30 crores by GST department for having some fake invoices. So we have to understand what was the reasons behind the penalty that was being levied by the department. First of all, I have to point it out that during the last 2 months, started from the late November and till recently, they have arrested around 329 pupils. They have raided, and they have collected around 1.15 lakh CR during December, and even 1.20 lakhs CR during the month of January itself. And we can expect a higher amount that is continue during the time to come, in the period to be follow. So we have to understand the thing, what was happened with LNT, and why we have to be more cautious about the developments those are taking place in GST scenario. So first of all, the case that was in related to LNT, basically they have collected some materials. They have got some input credits with them, and for that they have paid GST correctly. But on scrutiny of those bills, those purchase bills, basically, department have found those bills were totally fake. Okay, so since the invoice was fake, the invoice was actually invalid, the LNT wasn't entitled to have that credit, and they have to reverse the amount that was being claimed by it as, say, GST credit, and they have to pay the amount of GST, as well as they are liable for penalty also. And the amount of penalty, that was a huge amount, that is around 30 crores. So the issue that is being requiring our concern to be addressed here is why the department is more concerned these days, and what was the basic scenario. Yeah. So first of all, I would like to say that why we have got this concept of GST was what was the basic reason behind implementation of GST. What was the problem? Yeah, we have heard about that a person is say paying GST to someone, okay, and that GST is not actually being deposited with the department. Yes, these days, whether this can this practice can continue, let me suggest you that this practice cannot be continued, because we have got this GST number itself containing PAN number. Okay, first thing, and this PAN number can be help the GST department to find out the income tax related things of the person. One thing. Secondly, we have got a link. We have got a link between GST department, this income tax department, and various other authorities. Very recently, there is a MOU that is being signed by MCA and GST department also. So fundamentally, when a person is selling some goods to another person, say Mr. A is selling a commodity around rupee 1 CR to Mr. B, okay, he has to submit his GSTR1 with the GST department. This GSTR1 having mentioning of GST numbers of Mr. B, okay. This Mr. B is say our base person, okay. He has purchased some goods from Mr. A, and he is obviously selling these items to another person. And say at the time of selling, he has collected some amount of GST from that other guy, that other person. Okay. And obviously he is supposed to claim the amount of GST that is being paid by him to Mr. A. Okay. Now, say the output tax liability for him, say, is around 20 lakhs. And in input, he has got to pay, say, rupee 15 lakhs to Mr. A. Obviously, he is going to take the credit of this 15 lakhs, and he's supposed to pay the difference amount to the government. Okay. Previously, what was happening, Mr. B was claiming this 15, and there was no clue with the department. They were supposed to allow this 15 also, and this practice was continuously followed from, say, decades. But nowadays, when Mr. B is filing his GST returns, and due to linkage in between, the amount of credit that is being claimed by Mr. B, if it is not reflected in a specific form that is being provided to him, that is called Form 2A, the department is entitled to reject the claim. Okay, there is a recent amendment here also. They are allowing, say, 5% pluses. Okay, say one is claiming rupee 100 as credit and only 95 is reflecting. That is fine. The 5% difference is acceptable, but beyond this difference, department can refuse to allow you GST credits, and all this is possible because of the linkage provided in between. Even department has got very strong say MI tools with them, this AI tools, this ML tools, and they have got some deep data analyst systems available with them. They have got integrated data sharings with them, and with all the tools that is being available with them, they have got some business intelligence and fraud analysis system with available with the department. This is briefly called BIFA, and with the help of this, department can easily crack the fraud or say unintentional omissions that are being taken place. And L&T is the latest example in this scenario. Okay, I have to say recollect the things. They have got, I guess we all are aware that very recently they have made this 26AS form, income tax 26AS form amended. They have got a provision to show the sale that is being shown by us in our GSTR 3B, this GSP return. So even by going through this 26AS form, one can easily view whether the amount that is being reflected in his 26AS as his turnover or his sale is being matched with the turnover that is being shown by him or her in his GSTR 3B. This GSTR return department can also compare in between, and we have started receiving so many notices that GST department is claiming that in your income tax returns you have claimed that the turnover is 50 CRs, but in your GST return you have shown only say 40 CRs. The difference 10 CR you have to explain about. Okay. And very recently, the MCA, the Ministry of Corporate Affairs, have undertaken an MOU with CBIC, that is Central Board of Indirect Taxes and Customs. Now they have got data sharing in agreements between. Now the GST department is not basically depending upon income tax department. They can directly obtain the data from MCAs. That means if a company is filing its annual returns with MCA and showing its profit and losses, showing its turnovers with the Ministry of Corporate Affairs, it is Ministry of Corporate Affairs who will assist the GST department with the figures. Okay, if a person have filed, say the person is say interested to have bank finances, and for that, if he or she is manipulating his data, he has submitted say handsome financials with the bankers, and showing say very good turnovers and profits there, and obviously submitted the same data with the same data with Ministry of Corporate Affairs by virtue of its annual return filings. And yeah, they have some mischiefs. They have not shown these things correctly with income tax department. Okay, here the GST department is going a step ahead. They have got data sharing systems with income tax, and very recently they have got data sharing systems arrangements with the Ministry of Corporate Affairs also. Now they can have access to the data that is being provided by the company with MCA, and they can check whether there are mismatches, and in case of mismatches, one can say there might be huge penalties and even legal prosecutions that are going to be faced by those concerns. So, friends, I should conclude here say, by saying it's a very tough time ahead for fraudsters, or say even a genuine person have to be very cautious nowadays to file its compliances with income tax departments, with GST, and with even Ministry of Corporate Affairs also. So that's all from my side. And if you've got any say queries or doubts, I'm available here. I can be available to answer any query if raised by the members. So thank you, and please continue.
Hello,
Hello.
Anurag, you're waiting for me?
Hi, Aditya. I'm done.
Okay, you're done. Thanks so much, Anurag. Sorry, I actually had a urgent call. Thanks so much for your presentation. I think I heard most of it. Really great presentation, Santosh. Are you there? Uh,
Yes, Aditya. Hi.
I pass it on to you. It's nice seeing you again after a while.
Yeah, sure.
Yeah.
Just to check, am I audible and am I
Yeah, you
visible?
are perfectly audible. You are perfectly visible. You have the host right, so you can share your presentation.
All right. Before I start, good morning, everyone. I think this last session, I couldn't attend the IPO one, but I think this tax one was quite insightful, and compliments to Anurag ji for covering both the case studies pretty well and in simple language. I find the Tata direct tax case pretty interesting, and I think it's Anurag ji. This is kind of it will be like a milestone judgment, isn't
Yeah,
it?
yeah.
It may perhaps also have bearing on many multinationals who pay royalty to their parents abroad, parent
Mm,
companies abroad.
Denmark disease.
Okay, so friends, what I was asked to cover today are two things. So there is so for the initial part of the session, we'll discuss highlights of the financial reporting, key financial reporting implications of CSR amendments. So, as perhaps most of us know, that the CSR requirements under Companies Act, Section 135, was recently amended by way of a notification on, which became effective on 22nd of January 2021, and several proposals, several long-standing proposals which were made which were proposals which were made during the course of 2020 have now become effective. So that of course will have certain bearings on the financial reporting. So while there are various implications of the amendment operationally, so for example, now they are saying that CSR obligation is mandatory, or CSR there is a form which has been prescribed, CSR1, as per which electronically every company which undertakes CSR activity has to, file a return with MCA. So while there are several operational aspects of the amendments, the new rules that came into effect, uh, what is perhaps more important, since this is a group consisting of mainly auditors and practitioners, what is perhaps more relevant for us is the financial reporting implications, particularly given that we are approaching towards end of March and closure of the financial year. So there are about 3-4 key aspects that I have tried to cover here in this so to say mini section on how it will impact financial statements for March 2021. The second part of the session is again, I think Manoj shared, in the WhatsApp group a report. I think this was about a couple of weeks back by the Institute's Financial Reporting Review Board, FRRB. And this is the first time that the FRRB has undertaken a review of IndAS financial statements. So generally, as we all know, the institute's FRRB is a standing committee which undertakes reviews of general purpose financial statements. So all the financial statements which are available in public domain, and they come up with various observations. The extent of observations may vary. Some of them may be trivial. Okay, so for example, some disclosures having been missed, and so on and so forth. So in that case, what happens is they give an advisory to the company, and an advisory to the auditor, and they also refer those observations to the peer review board. In case they come across serious non-compliances with accounting standards, or in case they come across serious non-compliances which affect the true and fair view of the financial statements, in that case, they refer the matter to the specific matter to the disciplinary committee of the institute, and then the disciplinary committee can undertake further actions on the member, and so on and so forth. Obviously, the report doesn't mention the names of the specific companies that they study, okay, and therefore they would have statistics on how many financials did they pick, what were the sectors, which year, and so on and so forth. As I said, this is the first time that the board has covered IndAS financial statements, meaning which that it will be the first. So this is not like the latest IndAS financial statements that we would have seen. This is like the financial year March 2017, which was the first year for the first phase, non-NBFC companies. So while some of these observations, in fact, most of these observations will be relevant for current year also, some of the observations, particularly with regards to first-time adoption or IndAS 18 are dated, so may not be, now relevant anymore because the standards have changed, or it's not a first-time adoption scenario. So there are about 70 odd observations which the FRRB has come up with. Obviously, I won't touch upon all of them. Okay, most of them would be trivial, right? Some of the disclosures have not been covered. Some of the accounting standards, IndAS disclosures have not been properly made, or some of the numbers are not, consistently presented. So those kind of trivial observations I have kind of skipped. So I've selected about 9 to 10 major kind of observations, which I believe, there would be some learnings, some kind of, best practices for most of us, which we can take care in the March 21 financial, closure of our audit clients. So with that little background, let me just start the session. And of course, please do feel free to chip in whenever you have questions, or if you have any inputs, or if something is not clear, please do feel free to unmute yourself and raise questions. And or I'm not sure, Manojji, can everyone unmute themselves and speak, or is it like through a chat box?
Yeah, Santosh,
Yeah.
they can. So everyone, if they have any question, we'll prefer to make it interactive, and
Sure.
appreciate if you have any question, you can just unmute yourself and ask your question.
Yeah, thanks, Sandeep. So, and just to check, is the slide visible?
Yeah, it is visible. Can you put it into the presentation mode?
Yeah, sure.
Yeah, perfect. Yeah.
Okay.
And
So,
anybody interested in interaction, please put your video on and identify yourself, your name and company. That is essential before anything can be addressed.
and also just to add to what Manojji said, I see quite a few friends from the IndAS group. So I see Pankaj and Percy and some of the others also. So please feel free to chip in with your inputs and questions, or practical perspectives. It will be good to have a discussion, rather than just a monologue. So.
I would like to acknowledge this is a fantastic series. It's a very thick book, and so many companies are involved, so many different sectors, and there are different variations of compliances. There could be a series of about 10 to 12 presentations, and regularly different companies will be taken up. Please take full advantage of it. Every accounting standard, the compliances, and lots more to come.
Yeah.
Thank you, Santosh. This is an excellent initiative you have done.
Thank you.
And lots of experts, even from the Central Council, have highly appreciated this initiative.
Yeah.
And he would be joining in the future and be looking at each and every company being looked at in detail by real life examples.
Yeah. Thank you, Manoj. I see a raised hand by Percy Irani. Percy, any questions before we start? Any inputs? You want to speak something? Okay, perhaps.
In fact, I would acknowledge Mr. Shahrukh Vivani has joined. He has experience as a CFO, and he has also worked at various levels in audit and assurances in multiple Tata Group companies and MNC. And he has joined us and brought a lot of his other associates, CFOs and heads today and maybe in other series also. Feel free to interact on any specific issue relating to the topic being discussed.
Yeah. Okay, so as I just mentioned in the introduction, so this amendment rules, CSR amendment rules came into effect from 22nd of Jan 2021. Since last about 4 to 5 years, we know that Section 135 of Companies Act, it mandates certain classes. There is a threshold for net worth, turnover, and profit. Certain classes of companies to contribute towards CSR. Okay, now as we know, before these amendments came into effect, the wordings of Section 135 was either you contribute or you explain in the director's report as to why did you not make the CSR contribution, or why did you not have the CSR spend. So, you know, primarily, fundamentally, the section was not, it was not mandating CSR spend by the company. If you're falling short of, so it's 2% of your average net profit. So if you're falling short of that, then you had to explain, the directors had to explain the reason why that they did not contribute. So that is how we know that Section 135 was working, that either you make the CSR spend or you don't, or you explain. There was, of course, a format, a table that was prescribed, and as a part of the Schedule 3 disclosures, also there's a disclosure in the financial statements of the company. So there were, of course, there have been various discussions. There have been, a lot of interpretative areas. How do you calculate net profit? Okay, is it mandatory? Is it something that, what kind of explanation can you give for, not spending adequately, or, what kind of CSRs programs should you pick, whether you should go for ongoing or not, ongoing CSR finance. So as most of us perhaps know that there have been various interpretative questions or interpretative issues around CSR. Okay, and what these rules now amendments have done is that they have tried to clarify the aspects. Okay, many aspects have been clarified. Having said that, there will be still, quite a few areas where we will, will struggle as we go along. We will have, several questions and perhaps new questions popping up in our minds. But now, basically, what this new rule says is that Section 135, the amended standards, the amended section says that it's compulsory, it's mandatory to spend CSR, right? So we would have seen in many instances, in several, at least in my experience, many clients have had this, kind of letter from MCA. If they're falling short of CSR, as to why did they not spend and why did they not, write the explanation appropriately in the director's report. So while it was not something which was compulsory under Companies Act, but the perception was that the ministry or the government is perceiving this CSR as a very strict thing. So now with these new changes, it is clear that it has been, so the language of the section has been amended, and now it's a statutory obligation to make to spend towards CSR. The overview is, where it will mainly change is that now what the section basically says is that if you don't spend your required 2% of CSR, then within 30 days you need to deposit the deficit, the shortfall, with one of the funds, the PM CARES funds or the PM, national relief funds, as is mentioned in that Schedule to Companies Act, within 30 days, or in case if you have an ongoing project. Okay, an ongoing CSR project is basically where the CSR committee it commits itself to a CSR a CSR initiative uh, for multiple number of years. So for example, let's say if a company is saying that for next 3 years we intend to contribute, let's say 100 crores towards, say, welfare of women, or let's say towards public sanitation, something like that. So if it's an ongoing project which you have fallen short of, then in that case you don't directly contribute to the PM National Relief Fund or PM Cares Fund. You basically deposit it in a bank account which you would open with a scheduled bank. Okay, it's like an escrow account, so to say. And then during the next 3 years, you have to spend the money towards that ongoing project. Okay. And supposing if, at the end of 3 years, you don't spend, you still have a shortfall, then in that case, within 30 days, again, you would contribute to PM CARES or PM, one of those funds which have been prescribed. So that is basically how this would change, that it's no longer something which a company can merely say that we have whatever explanation. So for example, if it's a COVID scenario, I cannot as a company said that because of COVID, because of liquidity crunch, I couldn't spend. Okay, it is something that if you're not spending, then you have to contribute towards the PM CARES or one of those funds. So basically the bottom line is the government wants either you to directly spend money on towards CSR. And mind you, it's not that anything you can call as CSR under Companies Act. There are prescribed initiatives which have been identified in that Schedule 7. So basically, the government wants you to either directly yourself spend on CSR, or it wants, if you're not able to spend, it wants the money in one of those funds, so that if you're not spending, at least they would be able to have that corpus, and they would in turn use it for public welfare. So that is basically the major change which has come about. And this is something which the CSR committee, so a couple of years back, the MCA constituted the CSR committee to again, review the CSR requirements. And this was one of the recommendations that that committee had made. So this is, so in fact, most of the amendments that we have now are in line with the recommendations that that committee had made. Some of which were available by way of proposals during the course of last year. Obviously, we all know that because of COVID, they couldn't enact many things. They were a little bit slow to enact these amendment rules. Finally, in January 2021, last month they notified it, which means that it's effective now as we speak. So the first point, so from perspective of financial reporting, what are the, what is the key impact? So let's look at the first point. So as I said, CSR spend has been now rendered mandatory, and a company shall utilize the unspent amount of CSR for CSR activities. So the board of directors of a covered company shall ensure that the company spends in every financial year at least 2% of average net profits of the company made during 3 immediately preceding financial year in pursuance of the CSR policy. If a company fails to fully spend the CSR spend, it shall transfer the unspent amount to a fund specified in Schedule 7. If there is an ongoing CSR project, a company is required to transfer the unspent CSR amount in an unspent CSR bank account within 30 days of the end of the year. If this amount is still unspent for 3 years, the unspent CSR amount shall be transferred to a fund specified in Schedule 7 of Companies Act 2013. So until now, the way we were accounting for CSR, spend was that if a company is falling short of, spending its, 2% of its profit, we were not making a provision towards it simply because under, section 135, there was no mandate to spend. Okay, if you're not able to spend, you had to explain the reason why you did not spend. Okay, unless you have committed yourself for, you have entered into a contract, let's say, for spending the CSR amount. In that case, you would make a provision for it. But otherwise, if there is no commitment as such, there would be no provision towards unspent CSR amount. Now, with this amendment, the law has clearly now, been amended to say that if you're not spending on CSR activities yourself, then you should, either you should fund it to, one of the funds prescribed in Schedule 7, or if you have an ongoing CSR policy, or if you have an ongoing CSR project, in that case, you will have to deposit it in a special account, which you would, open up with a scheduled bank, and that you would spend over the period of 3 years. So, in short, the outlay of money is mandatory. Either you do it yourself, or you contribute towards one of these funds, and the government will spend it for you. So in either case, there would be an obligation towards on the company. It has now become a statutory obligation. So you will have to make a provision. So for example, if you are falling short, so if, let's say, based on the average net profits of last 3 years, if your 2% comes to, let's say, 100 crores, and until March you have only spent, let's say, 90 crores, this 10 crore shortfall will have to be provided for as of March, because eventually you will have to contribute that 10 crore to the fund, to the one of the funds prescribed in Schedule 7 within next 30 days. So there is definitely a obligation which is arising on the company, which you will have. So that is one big change. In fact, there was earlier, there is still a technical guide on CSR, on accounting for CSR activities, which perhaps the institute will now have to amend. That technical guide stated that it addressed the question that whether it's a statutory obligation. So of course, before this amendment, the answer was no, because you could have still explained why did you not spend, and there are no penal consequences. But now with this amendment mandating CSR spend, it will clearly be a different answer, meaning that you will have to make a provision towards. It's a statutory obligation now. So it's a legal obligation, not even a constructive obligation. So you will have to make a provision towards the shortfall as of March. So let me just pause here for a moment and invite questions or inputs in case I have not been clear on anything.
Do you have any study of which are the major companies affected because of that? Because these limits are there. Some of these companies, they complied with it and utilized the limit. Some had unutilized limits. And what will be the kind of real impact on some of the major companies in terms of amounts? Another point is would like you to address if any study has been done whether this amount, just because it is mandatory, it is being used. Is any real CSR work being done, or is it diversion of funds to friendly associates?
Yeah.
Many company CFOs and board members have expressed apprehensions that they are getting calls from various sources that you need to contribute compulsorily to this, and sometimes they are left with little choice.
Yeah. Yeah. So Manojji, see two, three things. About a few months back, I remember I had stumbled upon an article which had some statistics on how many companies are falling short of their CSR spends. I think it was a Prime database study or whatever. So where basically it quantified the number, and I think there were some names I don't recollect on top of my mind the names, but there were some names who were the companies with highest number of highest amount of deficit. There were apprehensions, obviously. So I don't have that statistics readily available, but I'm sure if you Google it out, there would be some, you would get some study or some statistics. On the second part, obviously there is, an apprehension that whether this CSR. So typically the way this works is, many of the companies, they start a Section 8 company or, fund, and they contribute amount to the Section 8 company or the fund. Uh, so obviously there have been apprehensions that whether this is something which is allowed, or is it just kind of promoters, companies making getting the money from the listed companies itself. I'm afraid I don't have credible statistics to show that which company is doing it genuinely, which company is not doing it genuinely. One thing in the amendment that they have, now prescribed is all those Section 8 companies need to be registered under, ATG. So you cannot have any company, any fund which is not registered. So again, they will be able to track the ingenuity of the NGO or the fund that you're creating for the purpose of CSR. The other thing is, I think many companies, and in my experience, a lot of NBFC, not a lot of FMCG companies were undertaking a lot of CSR activities and were kind of which could be perceived as a surrogate advertising. So, for example, let's say if a toothpaste company is undertaking dental checkups of in rural villages, it can be very well be perceived as a kind of a surrogate advertisement to promote its own brand and products. The amendment very clearly states now that anything which is like your business promotion cannot be counted as CSR. So any initiative, any program which is basically ending up promoting your own brand or own products cannot be counted as a CSR activity. There is one exception to this. They have added, they have inserted a proviso to Section 135 for companies who are undertaking research activities for drugs, vaccines, and medical devices related to COVID-19 in collaboration with, and then there are certain conditions to it. And this is only a proviso which gives, them a window of 3 years, 2021, 21-22, and 22-23, meaning which that for companies which are undertaking research activities for drugs or vaccines or medical devices for next 3 years related to COVID-19, that research cost would be counted as CSR activity. So obviously some of the, pharma companies and life sciences companies who are undertaking those activities, or if they desire to undertake those activities in next couple of years, they would probably, they would probably be interested in seeing whether it gets counted as CSR, and obviously that would reduce their CSR, spends.
Santosh, Mr. M. Narendra is here with us. He's a director on the boards of very large industrial groups and also a former chairman of top well-known banks. Lots of interest in the financial reporting